All right, let's dive into one of the timeless battles in the world of investing. It's this constant fight to figure out what a company is really worth, buried under all the chaotic noise of the stock market.
And it all starts with this one central question, a question that honestly trips up so many people. A real business doesn't just wake up one morning and become twice as valuable. So why in the world can its stock price do that? What makes the market seem so irrational?
Well, it turns out the answer is that there are two totally different games being played at the same time. On one side, you've got the market. Think of it as emotional, impatient, just completely obsessed with the latest news and trends. And on the other side, you have the analyst. This is someone who thinks like a sensible business owner, rational, patient, and focused on the long-term, durable value of the business itself.
So here's how we're going to break this all down. We'll start with that big divide between the market and the analyst. Then, we'll expose the illusion of averages and talk about why the story behind the numbers is so critical. From there, we'll look at some of Wall Street's biggest blunders, open up the analyst toolkit, and wrap it all up with a really important question for you.
Okay, let's jump right in. Section 1, the market versus the analyst. This is the core of it all, because they value a business in completely opposite ways. See, Wall Street is just fixated on what a company is earning right this second.
I mean, just think about this for a second. If you owned a corner store, you wouldn't wake up and say it's worth half as much just because you had a slow month, right? That would be insane. And yet, the stock market does that every single day. It treats these temporary ups and downs as if they're going to last forever.
And this obsession with the here and now leads us straight to our next big battlefield, how we look at earnings. The market loves a simple average, but a good analyst knows not all averages are created equal. What the analyst is really searching for is something called earning power. And this is not just punching numbers into a calculator. No, it's a judgment call. It's about looking at the entire business cycle, the good years and the bad, to figure out what a company can normally and dependably earn. It really all comes down to one word: predictability.
And this is a perfect example. Look at these two companies. On the surface, their 10-year average earnings look pretty similar, but when you look closer, it's a completely different story. SHK Crest was steady as a rock. That's true earning power. Hudson Motors, on the other hand, was an absolute roller coaster. Its earnings were all over the place, which makes its average pretty much meaningless. It's the stability that gives the average its value.
So if a simple average can trick us, what else does an analyst look at? Well, this is key. They look beyond the numbers. The market sees a nice upward trend and falls in love, no questions asked. The analyst, they start digging.
A true analyst lives by this rule. The numbers, the quantitative stuff, that's just the starting line. Those data points are only useful if you understand the qualitative story behind them, the industry, the competition, the management. You have to ask, does this business have some kind of built-in permanence?
And this is the massive difference. The market sees a rising stock and just assumes it'll keep rising forever. The analyst stops, takes a breath, and asks the most important question: why? Is this growth happening because the company has a real, durable advantage? Or is it just riding a temporary fad? Answering that one question can literally be the difference between making a great investment and, well, disaster.
And speaking of disaster, let's look at what happens when the market's logic goes completely off the rails. Get ready for two classic cautionary tales.
First up, Coty, the cosmetics company. Back in the 1920s, its earnings growth was, well, beautiful. It soared from under $1 a share to over $3 in just a few years. And the market, as you can imagine, absolutely fell head over heels. Just how in love was the market? Get this. At its peak in 1929, people were paying 30 times Coty's absolute best year of earnings. That's not investing. That's pure speculation. It's a wild bet that a popular trend is going to last forever. And of course it didn't last. The collapse was quick and it was brutal. But a real analyst would have seen the writing on the wall. They would have understood that the cosmetics industry is built on fads and trends, what the source beautifully calls the variable tastes of femininity. A peak in popularity is almost always followed by a decline. But here's an even crazier example. New York's Interborough Rapid Transit System. In 1917, profits were hitting all-time highs. The stock was soaring, everyone was euphoric. But here's the insane part. The company had just signed a public contract that mathematically guaranteed its future earnings were about to get crushed. It was right there in black and white. The market just completely ignored it, focusing only on that day's good news. And within 2 years, the company was totally wiped out.
So how do we avoid making these same classic mistakes? It's simple, really. We just have to trade the market's emotional mindset for the analyst's disciplined one, and that means having a repeatable process.
And this is that process. First, you figure out the company's real earning power by using a multi-year average, think 5 to 10 years, not just one. Second, you do a deep dive into the qualitative story of the business itself. And only then, for step 3, do you apply a conservative price tag, a reasonable price-to-earnings multiple.
So what counts as reasonable? Well, the analyst's method gives us a hard and fast rule, a ceiling. To make sure you're actually investing, you should never pay more than 20 times a company's average earnings. Anything above that, and you've officially crossed the line into speculation. You're just betting on future growth that hasn't happened yet.
This gives us a really handy way to categorize stocks. You've got your Group A companies. They might be great businesses, but their price is just way too high. So they're speculative. Then you have Group B. Their track record is just too erratic and unpredictable, also speculative. The analyst is hunting for companies in Group C, the ones that are quality businesses with stable earnings, all selling for a reasonable price.
Which brings us right back around to where we started. It all comes down to a fundamental choice about which philosophy you're going to follow.
And this leads us to maybe the most famous metaphor in all of investing. In the short run, the market is a voting machine. It's just a popularity contest. It responds to feelings and fads. But in the long run, it becomes a weighing machine. And eventually, it's the real substance, the true value of a business that determines the outcome.
So the final question is really for you. Whose game are you playing? Are you casting your votes every day based on emotion and what's popular, or are you patiently waiting for the scales to weigh the true substance of a business over the long haul?
And that's really the crucial takeaway here. The goal of an analyst isn't to be a prophet trying to predict the future. It's to be penetrating. It's about understanding the present so thoroughly, so completely, that you don't even need a crystal ball to make a sound, logical decision.